Hello and welcome back to Global Value. In today's video, we'll be performing a fundamental stock analysis of Church Dwight Co., ticker symbol CHD. Church Dwight is a dividend aristocrat. They have increased their dividend annually for the past 26 years. At the time of recording this video, Church Dwight is trading for just a penny under $95 per share. Church Dwight is down about 7% so far this year. Going back 1 year, they're up 11%. Going back 3 years to before the pandemic, Church Dwight has returned about 8.5% compounded annually. Going back 10 years, they've returned nearly 13% compounded annually. And going back over 17 years, they've returned 15% compounded annually. Keep in mind that this return is not including the dividends that they paid out. So Church Dwight is trading in between its 52-week high and its 52-week low, trending just a bit toward its 52-week high. It is a larger business. It has a $23 billion market cap. For some background about the business, Church Dwight is in the household products industry. They produce a lot of consumer staples. Church Dwight is the leading producer of baking soda in the world. Beyond baking soda, the products in its portfolio have vast category reach, including laundry products, cat litter, oral care, deodorant, and nasal care, all sold under the Arm & Hammer brand. Its mix also includes Extra, Trojan, OxyClean, First Response, Nair, Little Critters / VitaFusion, Orajel, and Waterpik, which together with Arm & Hammer constitute more than 80% of its annual sales and profits. In early 2019, the firm announced the addition of Flawless, which manufactures electric shaving products for women. At the end of 2020, the firm acquired Zicam, a leading brand in the cold/cough shortening category. Church Dwight derives more than 80% of its sales from its home market in the United States. The company was founded in 1846 and is headquartered in Ewing, New Jersey. For our fundamental analysis, we'll be performing a modified version of the 8-pillar analysis popularized by Everything Money, taking a look at 8 key financial metrics for the business and coming to a holistic beginning understanding of Church Dwight based on those fundamentals. So let's get right into it. Starting off with pillar number 1, we want their average 5-year PE to be below 22.5. So currently, Church Dwight is trading for 29 times earnings. Over this time period, they got all the way up to a high of 34 times earnings and all the way to a low of 15 times earnings. However, averaged out, they've traded for nearly 27 times earnings, so that's going to be an X to start off on pillar number 1. Pillar number 2, we're looking for an average 5-year return on capital that's above 9%. Church Dwight maintains very steady returns on capital. Over this time frame, they've averaged a pretty steady 15% return on capital. So over the long run, over the course of decades, a stock is going to return approximately what its underlying business returns, and those business returns are captured here by return on capital. Church Dwight is steadily and stably able to produce above average returns on capital. So that's our first check on pillar number 2. Pillar number 3, we're looking for 5-year revenue growth. Church Dwight has grown revenues from nearly $3.8 billion in 2017 to nearly $5.2 billion in 2021. So that is going to be another check on pillar number 3. Pillar number 4, we're looking for 5-year net income growth. Church Dwight has grown net income from $743 million in 2017 to $827 million in 2021. So that's another check on pillar number 4. That's 3 checks in a row now. Pillar number 5, we're looking for decreasing shares outstanding. When you purchase a share of stock, what you're really buying is a fractional ownership percentage in that underlying business. When a company buys back shares and decreases their amount of shares outstanding, that increases your ownership percentage of the business without you having to pay any money, which ultimately means that you're going to be entitled to a higher percentage of the business's profits going forward. So Church Dwight has bought back shares over this time frame. They've reduced their shares outstanding from 256 million in 2017 to just under 250 in 2021. So not a ton of buybacks here, but their share count is coming down, and more importantly, they have not been diluting existing shareholders through these various acquisitions that they've been making. So that's another check on pillar number 5. Pillar number 6, we're looking for 5-year free cash flow growth. Free cash flow is cash from operations minus capital expenditures. It's this column here in green. Free cash flow is the lifeblood of any business, And a business's abilities to produce free cash flows is ultimately how that business should be valued. Free cash flow can be used to pay dividends, buy back shares, pay down debt, make acquisitions, or reinvest back into the business. In 2017, Church & Dwight produced about $636 million of free cash flow, and that has increased to $875 million of free cash flow in 2021. So that's another check there on pillar number 6. That's 5 checks in a row. Based on this free cash flow profile, Church & Dwight does not have to spend very much money on capital expenditures relative to their cash from operations. The business has been able to grow with only incremental reinvestment. Relative to their capital expenditures, they're producing a lot of cash from operations and a lot of cash flow overall. So this, coupled with their strong returns on capital, are some of the hallmark signs of being a great, stable business. In an average year over this time frame, Church & Dwight is producing about $780 million of free cash flow. So we'll be using that number in pillar 7 and 8 coming up. Pillar number 7, we're evaluating how the business utilizes leverage. We don't want to invest in over-levered companies. We want the businesses we invest in to be utilizing reasonable amounts of leverage. The reason being is that during times of economic hardship, it's the highly levered and over-leveraged businesses that are going to get into the most serious trouble. For pillar number 7, we want their net debt, which is long and short-term liabilities minus cash and short-term cash equivalents, to be below their average 5-year free cash flow multiplied by 5. So at the end of last year, Church & Dwight had $2.5 billion of net debt. When we multiply their average 5-year free cash flow of $780 million times 5, that brings us to $3.9 billion. Based on their ability in an average year over this time frame to produce free cash flows, they have more than enough cash flow generation to be able to pay off all of these debts. That's a sign of a healthy business that's not over-levered, and that's a check on pillar number 7. We've had 6 checks in a row now. Finally, the big pillar of them all, pillar number 8, we want their market cap to be below their average 5-year free cash flow multiplied by 20. So Church & Dwight has a $23 billion market cap. When we multiply their average 5-year free cash flow times 20, that only brings us to about $15.5 billion. That is going to be an X on pillar number 8. We're off by nearly $7.5 billion there. Using that 20 times free cash flow number is just a starting point as to try to give us a reasonable valuation of what to pay for the company. Just because pillar number 8 was an X doesn't necessarily mean anything in isolation. You want to take this analysis holistically, and at the same time, this type of analysis is a starting point of determining whether it's worth your while to do further due diligence and learn more about the business. It's not any sort of financial advice. Then, as mentioned, Church & Dwight is a dividend aristocrat. They've increased the amount of dividends that they've paid out in each of the past 26 years. So here we're looking at their dividend profile. Investors often make mistakes by blindly chasing what they perceive to be safe dividends or stocks with high dividend yields. Even though Church & Dwight is a dividend aristocrat, it's important to determine whether or not their dividend is healthy and supported by their free cash flows. And here is where we get to see that full picture. Church & Dwight is paying out less than half of their free cash flows as dividends. They've pretty much been able to raise their free cash flows in each of these 5 years, with just a slight drop year over year from 2020 until 2021. And over this time frame, they've increased their dividend. So Church & Dwight has what looks to be a very healthy and potentially very sustainable dividend. It's likely that they'll be able to continue increasing their dividends that they pay out now and well into the future based on this dividend and free cash flow profile. So that is a very reassuring sign that this business potentially has a long runway as a dividend growth stock. So in summary, Church & Dwight checks the box on 6 out of 8 pillars. They exhibit strong business fundamentals, and they're only off on our valuation pillars. Their dividend looks to be in great shape, and they've been increasing that dividend each year for the past 26 years. It looks like they've got a long runway ahead of them to keep increasing that into the future. Church & Dwight is also a position in the Fundsmith portfolio managed by Terry Smith, who's been referred to as the Warren Buffett of Great Britain. It makes up a smaller percentage of the Fundsmith portfolio, under 3%, but it's been a relatively stable position for them over the years. So again, this type of analysis is a starting point. It's not financial advice. With that said, that's it for today's fundamental stock analysis of Church & Dwight Co. Inc., ticker symbol CHD. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Church & Dwight was a subscriber request, so thanks for learning about Church & Dwight with me, and have a great day.